Exactly. Since it is 100% ownership, we don't have to deal with anyone else. It's just one big group now. So, here's the big idea. We are basically just adding their stuff together, but we have to be careful not to double count. Imagine Pegasus bought Sylvester's house. On the group's books, we can't show the house and the cash Pegasus used to buy it if we're looking at them as one single unit. This is the part that trips people up. Look at that calculation. Pegasus has an asset called investment in Sylvester for 1.3 million. But Sylvester has equity, share capital, and retained earnings. That also totals 1.3 million. When we combine them, the investment and the equity cancel each other out to zero. It's like they never happened. Does that make sense why we can't show the investment and the equity at the same time? Spot on! Now that we've cleared the air with that cancellation, we get to do the fun part, the mashup. Check the table I'm building. We take the property, plant, and equipment from Pegasus, which is 20,000, and add Sylvester's 900 to get 20,900. Simple addition, right? We do the same for inventories and cash. But wait a second. Looking at your source materials answer, the share capital is only 5,000. That is just Pegasus's amount. Why do you think we didn't add Sylvester's 100 of share capital to the total? No worries. This is the most common mistake students make. Remember that cancellation step we just did? When we get what, my friend? You want to see the rest of the numbers? Or maybe that final consolidated statement we're building? You got it. Let's pull the data straight from your screenshots and build this thing exactly like the official answer. I'll show you every single calculation so you see where those numbers are coming from. Okay, look at the assets first. We literally just add across. 20,000 from Pegasus plus 900 from Sylvester gives us that 20,900 in PPE. Then we do the same for inventories, receivables, and cash. If you add all those up, you get 27,800. Boom. Now for the equity side. This is the golden rule. For share capital and retained earnings, we only use the parent company's numbers. So we take 5,000 and 19,450 straight from Pegasus. We ignore Sylvester's equity because we canceled it against the investment earlier. Then just add the liabilities across like we did with the assets. Check it out. Both sides hit 27,800. We are perfectly balanced. Does that step-by-step math from the picture make sense to you now? All right, let's trace every single digit back to your source material. Look at the first table in Activity 2. For PPE, I grabbed the 20,000 from the Pegasus column and added the 900 from the Sylvester column. That gives us that 20,900 you see in the answer screenshot. Now, notice how the investment in Sylvester, that 3 tonner, just disappears in the final answer? That's because it's replaced by Sylvester's actual assets and liabilities. To balance that, we also have to ignore Sylvester's equity, the 100 for share capital and the 1200 for retained earnings. We only keep Pegasus's equity numbers, 5,000 and 19,450. Is it clear how I'm picking those specific numbers from the Pegasus and Sylvester columns to create the final total? Boom! You are a natural at this. Since you've got the hang of how we mash those numbers together and cancel out the internal stuff, let's wrap this up with a quick summary and some flashcards so you can crush any problem like this. There you go. Everything is on the board. We took the numbers straight from your material, added them up, and applied the golden rules of consolidation. You feel like a pro at this now, or is there any other part of that picture you want to zoom in on? You got it. Let's run it back with some fresh colors to make every step pop. Round 2. Let's go. I've set up a color code for us. Black is our starting data, blue is where we add things together, and red is the danger zone where we cancel things out so we don't double count. First, the assets. We take the PPE, inventory, and cash from both columns in your notes. Since they are now one group, we just add them together to get these blue totals. Pretty straightforward addition. Now look at the red. This is the cancellation. Pegasus has an asset called investment for 1,300. Sylvester has equity for 1,300. If we kept both, we'd be counting the same value twice. So, they both get the axe. They do not show up in the final total. For the final section, we look at equity. Since we canceled Sylvester's equity in the red step, we only pull the 5,000 and 19,450 from the Pegasus column. For the liabilities like payables and tax, we go back to blue and just add them up across the two companies. And check that out. When you add it all up, both sides match at 27,800. Does seeing it color-coded like this make the difference between what we add and what we cancel clearer? Boom! You're crushing it. Since you've got the hang of the math and the cancellation logic, let's lock this in. You now know exactly how to take two balance sheets and merge them into one powerhouse group statement. Quick question for the road. Since Pegasus owns 100%, whose retained earnings did we use in that final consolidated answer? Bingo! You nailed it. We only care about the parent company's retained earnings in this setup. You've officially mastered the Pegasus and Sylvester consolidation.